Hello, and welcome to this Gowling WLG pre-recorded panel. Today we're going to be looking at the recent flurry of activity of Canadian mining companies that have been dual listing in London. Last year was particularly busy with a stream of Canadian companies setting up store in London, such as Pure Gold, Taseko, Yamana Gold, and Wheaton Precious Metals. On this video, we wanted to touch upon some of the reasons that companies have decided to take this route, how they've done it, and what are the pros and cons of doing so. By way of introduction, my name is Charles Bond, and I'm a corporate finance partner and head of Gowling WLG's mining group in London. I'm very grateful to the other participants on this call today who are joining us. First of all, we have Rusty Bell, who's the managing director and head of corporate finance at Velocity Trade Capital in Toronto. Velocity is a global equity, foreign exchange, and precious metals broker. We're also very grateful to the London Stock Exchange for joining us today in the form of Chris Mayo. Chris is head of primary markets for the Americas. Also on the corporate finance side, we have James Asensio from Canaccord Genuity. James is based in London and is a member of Canaccord's very busy natural resources investment banking team. And last but not least by any means, we have a representative from a Canadian company who has just completed their own London listing, being Richard Williams, the Chief Executive Officer of Cornish Metals, a mineral exploration and development company focused on its mining projects in Cornwall, being the flagship projects of the United Downs Copper Tin Project and the South Crofty Tin Project. Thank you all for joining us, and we look forward to your views today. Rusty, if it's okay, I'm going to start with you. I know that you've been involved in a lot of these dual listing deals over the last 18 months. Maybe you could talk a little bit about why Canadian companies are choosing to do this and why they want to do it at the moment. And then we can open it out to the others.
Sure, thanks, Charles, and thanks for allowing me to join today. Appreciate it very much. We've done a significant amount of work. I just maybe seeing the landscape a little bit, going back. We look at the Canadian mining marketplace 15 years ago, and we look at the specialist pools of capital. Those pools of capital were somewhere in the neighborhood of over $20 billion. And we had on the TSX and TSXV probably 1,500 plus mining companies, public mining companies. When we started to take a look at what I think we reference as kind of the capital depletion dynamic, we went back about 6 years, and 6 years ago we saw that pool of capital from 20 billion go down to I guess it was just hovering around 6 billion. And today, frankly, that same pool of capital is just over 3 billion, and we have 1,200 companies listed between TSX and TSXV. So not to be sort of negative about the environment, because Canada remains to be one of the the biggest sources of access to great mining companies and a great incubator of mining companies. But it was a clear realization that Canadian mining companies, when you have 1,200 companies chasing $3 billion or $3 billion chasing 1,200 companies, it's an unsustainable model at this point. And so we took a very aggressive route to look outside Canada for different pools of capital. And London was an obvious place for us to go. But maybe I'll just take a step back and talk a little bit about why there was this significant capital depletion dynamic. And we kind of look at it as 4 legs to a stool. And in some senses, it's a perfect storm. The first leg, obviously, I guess arguably the mining sector has been slightly out of favor for the last 10 years. But the biggest impact was in passive investment. So, the proliferation of ETFs and passive investment vehicles was massive in Canada and North America. In particular, in Canada, we have now over 100 ETFs, whereas in London, there's, I think you're going to struggle to find 10 ETFs. So passive investment was just pulling huge flows of capital out of those specialist active managers' hands. What that did, unfortunately for them, is it created an environment where if you're facing redemptions, you need to hold on to securities that have higher liquidity levels. And if you have higher liquidity levels, you more likely are looking at higher market cap companies. And that means it's very difficult to invest in the earlier stage exploration, earlier stage development companies and limits the number of companies you can invest in. The second leg of that stool is probably momentum sectors. We've gone through a few variations and we're kind of back to one of them, but certainly the activity around cannabis and the activity around cryptocurrency has been substantial in Canada, and the diversion of capital going to those sectors has certainly impacted the junior mining space considerably. And then, thirdly, when you look at MiFID II, which a lot of people in Canada don't completely understand, but is a really important part of the rationale behind the capital depletion dynamic, but is much more difficult for Canadian companies to have their stories or their opportunities published, distributed, or reach a global audience, especially and specifically in the UK and the EU. And that's had sort of a backdrop or backroom kind of impact on those companies. And then the last one, which frankly I believe we're going to start seeing more of, is this surge in ESG. I mean, ESG has now become the single largest category of investment flows globally, and without question, it's coming to Canada, very quickly. And if you're part of a big marketing engine, those marketing dollars are going to, the funds that are most attractive, and that further puts pressure on these Canadian fund managers. So, that was, again, I don't want to be negative because Canada is a very robust market, and commodity prices are moving the right way, but it did for us really identify, the pressure that Canadian fund managers were seeing. And that obviously translates into 1,250 companies in Canada having a more difficult time accessing capital. And that led us, not to speak for too long because there's a lot of areas of interest here, but that really led us to the relationship we developed with the London Stock Exchange about 4 or 5 years ago, and Chris Mayo and Tom Attenborough and their entire team have been fantastic and further contributed to the data that we now have sort of compiled. And the experience that we've had identifying what companies in Canada truly work in different exchanges, and specifically why these companies can succeed so well and access greater pools of capital on the London Stock Exchange.
Thanks, Rusty. Chris, maybe you're the natural follow-on from there. I guess a lot of that chimes with your experience when talking to North American companies.
Yeah, I think that's right, and I think just to move on from Rusty's point, we don't see this as a kind of either/or conversation. We see this as something that can be complementary to mining companies' existing, Toronto listing, and so we think they can add additional investors by taking this step. And I would say also, what we also believe is that the additional burden of doing this once you're already listed in Toronto is not that significant. So it is something that a company can add. Okay, it's not cheap to do a listing, but I think that the additional burden relative to doing things in other markets from Canada to London is actually relatively modest. And I think that's why it's an attraction to these kind of companies. What I would also say is that, there's almost a kind of life cycle argument you can make here where, Canada has a lot of really early stage companies and has been very good at financing those kind of companies over the years. Where I think London, as companies start to mature and move through their development cycle, London can be a really good source of additional capital for those kind of companies. But I think it's important to say we're not just catering to large companies, we're catering to companies of all sizes. So if you take, obviously, Cornish Metals, as we have on this particular webinar, they're a small company with great potential, relatively small. But then if you look at other companies we've had Yamana, probably $6 billion when it went public, when it added the UK listing, Wheaton, $20 billion, and you have Pure Gold that was probably just over $100 million, now obviously a lot larger when it added its London listing. We believe we can cater to companies of all sizes through London, and that the investor base is really looking for high quality mining opportunities, and we can add something to the kind of investor platform that existing Toronto listed companies already have.
Yeah, I think that's a really important message, Chris. I mean, certainly what was attractive to the companies we represented was the process of the standard listing. I mean, there's multiple ways of listing in London, but the standard was a major advantage for especially Canadian mining companies. One, it was cost effective. Two, all of your regulatory and compliance reverted back to home country, so it wasn't a duplication or a further burden for them. And the ongoing costs, because that regulation and compliance reverted back to home country, was quite nominal for them. So in the case of, and the success in doing that was quite efficient. And as you mentioned, we listed Pure Gold, I guess, at about $110 million market cap, which is, it's touched on $1 billion market cap now, pulled back a little bit, but maybe around 800 million. Taseko's, another one that we did with you, and that was again about $120 million market cap when we listed, and that's about $600 or $700 million market cap now. And then, the ability to break ground and then bring a company with the likes of Yamana Gold, which is one of Canada's most prominent multiple asset gold companies, and to bring them to the London Stock Exchange, I think really got the attention of so many more larger companies and seeing the advantage of that. But they've all had tremendous success on the back of the standard listing. And one of the challenges from a marketing standpoint certainly has been in Canada, the number of people you can go and tell your story to. And in the case of those three companies I brought up, we've had well over 100 anyway, new institutional investor meetings for all of those companies, and the participation is showing. Certainly in the case of Pure Gold, more than 20% of their daily volume is now traded on the London Stock Exchange, and that's in a fairly relatively short period of time. And
Well, maybe we should ask Richard, given you've got the most recent experience. I mean, I know you've been planning this for some time, but and obviously you're probably one of the only listed UK assets, which is great for the UK, but I'm sure that wasn't the only thing that brought you from Canada to London. What were the other reasons that persuaded you to come and list here, Richard?
Well, I'm not sure I entirely agree with all the statements so far. I think for a company of our size, and certainly at the exploration end of the business, I think Canada really understands exploration companies, the risks involved. As you advance a project, there's always dilution that comes into the story because you need to raise more money and advance the project. And I think there's a real difference in the view of investors in the UK compared to the view of investors in Canada when it comes to understanding the exploration cycle and what that involves. And also, I think for smaller companies, the additional cost of listing in the UK, right at the small end, anyway, at the exploration end, might be too much. From our perspective, having a project in the UK, there's really not many for investors to look at. So the attraction for us was really exposure to the UK investment community. And a lot of it comes down to timing as well. As you'd alluded to, we did try to list in 2019, but at that time, the headwinds were against us. And I think, for a number of reasons that were completely beyond our control, we weren't successful in 2019. We all know that the resource sector is a cyclical business. And, at this point, we started our process for listing last summer. And our initial kind of target was to be listed before Christmas. And, our experience is that there's a tremendous amount of work involved. And maybe that was just, particular to our situation, some of the issues in the UK exploration and mining sector may be different to other parts of the world. But we ended up listing in January, and that also coincided with strong growth in the copper price, the tin price, and investor interest in that. So, we've benefited from timing this time around. And it's certainly, what we've seen in the last week, which, Rusty and Chris alluded to, tremendous liquidity since we've listed. Certainly not the kind of liquidity we've seen in Canada. And so a lot of it comes down to, I think in our case anyway, local interest to see projects in the UK advance. But, I think that certainly at the earlier stage, companies need to understand that there is a different outlook from investors in the UK when it comes to dilution versus Canadian investors' understanding of what it takes to go from, generation of a project, discovery of an asset, advancing it through to resource stage, PEA, feasibility. So, I think from our perspective, at our size of company, it made sense because it is a UK project.
Okay, so maybe James, we can ask you a question from the broker investment perspective. Rusty had already touched upon the different types of markets in the UK and some of the benefits of a standard listing. Do you want to just maybe, for any kind of Canadian companies out there listing, just explain some of the differences between AIM and the standard market and what you would normally recommend for each type of company?
Sure, very happy to. Look, I think the starting point, the way we look at it is really about what type of company it is, what state of development it's at, and what therefore the kind of the likely investor appetite will be for that company once listed in the UK. I guess within that, obviously, AIM is considered to be the junior market, and therefore, there's a kind of a set investor audience for it, and then the general perception is that if you go to the standard market, the investor audience does widen, and the allocations from portfolios can increase on that basis. However, I think what is important to note is that, at least from the investors that we speak to, and we're very, very much focused on small and mid-cap investors, both generalists and specialists, the reality is that there's only really one investor up in Scotland that can't invest in AIM. Most of the other guys can invest on AIM and the LSE. So from an investor targeting and capturing that investor appetite, we don't see a huge issue between AIM and the main market. So then it goes really into what are the company's objectives, medium and long term. And I think I would say, typically what we would tend to advise, if it's a an emerging developer that is going to require significant capital or a couple of rounds of capital raising in the short to medium term, they should probably look more towards AIM to get to that to that consolidated platform of a junior producer of a junior producer level. If it's more a consolidated producing company, we would typically advise that they should go down the standard segment route, and if applicable, the premium segment, obviously. So I think that's kind of the broad strokes of the advice we tend to give. I think it's very tailored to each company, each project, but I think the ultimate kind of decision making has to come from where are you likely to get the most investor appetite, and that's on a case by case basis along those parameters.
And just following up on one of Rusty's other points as well, where you noted the ESG influence over the investment community at the moment, is that something you're also seeing here in the UK, big impact of ESG investors?
Absolutely. I mean, I'm not 100% familiar with North America at the moment, but I would say that actually the UK is probably leading the pack in terms of ESG investing and setting what the appropriate ESG standards are for mining companies to be following. Now, the discussion comes to what are those standards, and kind of standardizing those standards, because it's a bit complicated at the moment. But for sure, we're seeing most investors of a certain scale have their own ESG teams internally that look at every investment on its own ESG merits, and in some cases don't even allow portfolio managers to continue with their investment thesis if it doesn't tick the ESG boxes. So absolutely, it's an absolute requirement to have an ESG focused strategy for each company, and I think it's definitely going to be a growing trend going forward.
Chris, maybe I can just turn to you now and maybe ask a little bit about the process from the LSE's perspective. What do you do to kind of help to these Canadian companies come to London, the services that you offer, and how you maybe make it a little bit easier for them? And are you anticipating any changes coming up through the pipeline which may make it even easier?
Well, yeah, I mean, there are a couple of things to say there. I mean, obviously, at the start of the process, what we do is we try to act as kind of the first point of contact for a number of companies, just to explain to them what the process is. We talk about the differences between AIM and standard. We provide connections to the relevant advisors, people like Gowling and people like Canaccord and people like VT. So we're there to kind of be the first port of call for information. The company is considering listing in London, and talk through the the pros and cons and the costs and all that kind of thing, and we try to demystify that process. So that's one part of the things. I think what you're also alluding to are what changes may there be from kind of regulatory perspective to make it easier to list. So I think that there is an ongoing review going on at the moment with regards to competitiveness of the UK listing regime. I actually think the UK listing regime overall is pretty competitive in terms of its flexibility, and having both AIM and standard as alternatives makes it so. I would say that things that this is in the press, things like dual class voting stock, which actually is possible in the UK already, but making that more formal, things like reduction of free float requirements. These are all things that are under consideration that may come out of the Lord Hill review, but that'll probably be published in the kind of the near term. I think something specific to mining and actually also oil and gas that may come up is the fact that more flexibility about the inclusion of a competent persons report or a mineral experts report in a prospectus, and the need to have that as an existing listed company from, say, Toronto or New York. There may be changes that happen in that area which would make it more flexible, but we'll have to wait and see what actually comes out of the review.
Rusty, from your perspective in Canada, is that something that Canadian mineral companies would welcome? I guess anything that cuts down some of the red tape would be good.
Yeah, but absolutely. Listening to James and what Chris was just talking about with regards to Canadian mining companies coming over and deciding on which platform or which exchange to list on. One of the things that we initially took some pushback on was on the route of the standard listing, simply because there were a lot of people telling us that they wanted nomad representation. And what came from that was quite fascinating, in the sense that for mining specifically, the standard works so well in London because of all of the regulatory burden they go through in their home country. So when they actually arrive in London, and when you talk about, Chris, the 43101 and everything else, they're actually super compliant already. And that was, that's a hurdle that we initially went over, and now I think that's, very much clear sailing. So another huge advantage and as Richard mentioned, you've got to be at the right stage to take advantage of the standard listing. But if you are, that's a huge advantage for them, definitely.
I think we're also hoping as well that the review may also address some of the inequity maybe for royalty companies, which are obviously very popular in Canada, have been very successful, and which we probably have too few in the UK. And it's always been difficult for royalty companies because we have a material assets test, which may catch a number of different royalties held by a royalty company, meaning they have to produce a competent persons report on every one of those, which becomes untenable, really. So it'd be interesting to see for royalty companies if they'll be given a bit more of an easier ride in this review as well.
What I would say is that Wheaton will have done that exercise. So at least there is recent precedent. Obviously, they're streaming rather than a royalty company, but there's a similar kind of principle behind that. And I would hope, as you say, Charles, that there will be. I think there's certainly appetite for more royalty and streaming companies in the UK. So I'd hope that there would be, more opportunity for those companies to list in London going forward.
Yeah, definitely. Maybe we could just talk about kind of the practicalities of costs and timing. I know you've already said, Richard, it maybe took a little bit longer and cost a little bit more than you thought it might do. James, in your view, when you talk to companies, how do you prepare companies for that discussion?
We tend to be as upfront as possible with the kind of granular costs that would come with the listing, and I guess put them in a kind of a worst case scenario, both in terms of cost, but also timing, because I think, you know, the typical timelines that you see online in the various guidelines that people would look at would give you kind of a sense that, you know, 3 to 4 months is the kind of the easy timetable to follow. And I think, you know, we tend to guide people up front to the fact that yes, that's the standard, but there are, you know, depending on the complexities around the projects and you know, the assets the company own, it may be longer. So that's something that we work with them through them quite a lot. So that's one. And then of cost, I think it's again it's a matter of, you know, being granular and really assessing, you know, each and every bit of each company's requirements, and determining, you know, within the range of costs that you would typically have for a listing, where are you likely to fall? Are you likely to fall on the kind of on the lower end or the higher end? And I think, again, you know, going back to my point in terms of, you know, standard versus AIM, I think there's no kind of one size fits all, and it all has to be, you know, very tailored, and you know, in our view, that kind of tailored advice needs to be provided very much upfront for companies to understand exactly what they're getting into, you know, from the first moment.
You know, one of the things that we're often asked is, you know, the ongoing costs for a standard list versus an AIM list. Obviously, if you're on AIM, you have ongoing fees to pay to your nominated advisor, which you don't have to do for a standard list, but then you have other costs to incur. So, for example, if you want to issue more shares, more than 20% of your issued share capital, then at least in the first 18 months, you may have to issue another prospectus. So I think there's always a balance to be had in these things. I don't know, Chris, if you agree with that one.
I do, actually. I think it's important to say that all these costs are transparent from an exchange perspective, and I think advisors will be open about this too. And, you know, standard from an exchange perspective, our costs are higher. So the admission cost is higher, the annual fee is higher, and also the admission cost for newly issued securities and follow-on offerings, as you're talking about, is also higher. But as you say, on the flip side of that, you will not have the cost of a nomad. So there are, you know, the kind of pros and cons to looking at this, and that is why sometimes when we see smaller companies which have large capital requirements, you know, are going to raise a lot of follow-on capital, they may look to AIM for that reason, because, you know, if you think about over a number of years, the costs may be lower from that perspective. But certainly the larger companies we've looked at have also looked to standard, because, you know, they'll say, well, we are a larger company, you know, we're already listed in Canada, we don't need to have a nomad, you know, the standard listing fits our requirements perfectly, especially as we can take most of what we're doing in Canada, as Rusty's already alluded to, and just basically use that in the UK without having to change much at all. So I think, you know, these things are transparent. You can look at the fees for LSC on our website, and they're, you know, there for all to see, and you can actually do the calculations yourself.
Richard, when you look back over the last 6 to 8 months, was there anything that caught you unawares? Anything you would wish you had known at the start of the process?
Not really. I think we'd been, even from the day one when we acquired the Cornish assets, I think we knew right away that this was a company that should have a UK listing. So we'd been working on it for a long period. I think certainly differences in how directors are viewed by the authorities in the UK versus Canada, and what is classed as independent. There's some differences of opinion there. And I think if you are going to list in the UK and you've just got a Canadian slate of directors, you are going to have to look at UK representation as a non-exec director, 1 or 2 people. So there is a change in that regard. And some of the other things that are, it's just differences of how people view and investors view the companies. I think there's, in Canada, it's fairly typical to offer directors and management stock options. It's not as common to UK listed companies. In fact, I think investors view directors in the UK as having options as potentially a conflict of interest. Whereas in Canada, a lot of companies just don't have the financial capacity to pay directors on top of, the other costs for running the company. So there's, those things you need to be aware of. Also, I think UK investors typically, from what we saw anyway with our recent listing, prefer financings to be straight share issuances rather than unit offerings, which are more more common in Canada. So there's, again, a different view of the attraction or the pros and cons of warrants from a financing. So they're things that you just need to be aware of before you come to the market.
Yeah, I think it's fair to say we're sometimes separated by a common language with our Canadian colleagues when it comes to some of these things. Rusty, from your point of view, what does the future look like for these dual listings? Are you still seeing a lot of demand?
Absolutely, Charles. I think we all have to be understanding of the environment that we're in, and I think it's really important for any management team to understand that by getting a listing, whether it's on AIM or standard or premium, but it's not flicking a light switch. You have to put the work in. You have to build a relationship and rapport with new investors. It comes with tremendous amount of advantages if you use the toolbox properly, and I think that's what we're certainly experiencing now very positively, is we've really created significant infrastructure on the ground in London. It is a very exciting opportunity for a lot of management teams, and it looks really good on a spreadsheet. But at the end of the day, to make it work, there's a lot of pieces that have to be in place. And for ourselves, working with Gowling and working with other legal teams has been an experience, and everyone brings different advantages. But we also work with almost all the communications groups on the grounds in London, from from Brunswick and FDI down to not down to, but with Buchanan and Tavistock and Camarco, and then we also it's really important that as Richard is he's using 2 joint brokers in SB Angel and Hanneman Partners, but there's a number of different brokers, and they all bring different things, and they all have different relationships. So it's really important that you manage all of those sort of advantages that you get out of the London market, properly. We certainly help, with navigating that. But yeah, I guess back to the question is there still appetite to go to London? I think there's massive appetite to go to London, and I think there's a lot of people hesitant because of the current environment we're in right now. But we'll certainly probably bring 3 new Canadian well-known companies to the market this year, and I suspect as we see as the traction increases, which it is, I think many more will follow. So we're very
if you're pleased. A Canadian miner looking at this video, and you're now just beginning to pick up this idea, how far ahead do you think you have to plan this? Are you talking about a year, 6 months, or shorter?
Honestly, it really depends on the and I'm sure you would agree with this. It depends on the management team, because this isn't an easy decision for a company just to go ahead and do. So it requires board approval, and that seems to be the holdup, is when can we get the board together? When can we? And there's always someone that has a question, and you've got to go back to ground zero and go through it all. But I think once you get through the initial decision process of this is something we should do, as James alluded to, it's a very, for us, it's been a very efficient process, and it is about a 3 to 4 month process. And we like to look at it as the initial submission of the prospectus and the initial documents of the UKLA, which we would do with Gowling, and then making an intention to list or an announcement. And by the time we make an intention to list, we certainly would hope that we're within, I think on the outside, a couple of months of first day of trading. And then we create, with the infrastructure that we've built on the ground in London, the momentum to ensure they have a good reception.
Okay, maybe just a couple more questions. One, maybe for you, Chris. If you're a Canadian company and you're possibly being attracted, because it's very hot at the moment, to the Australian stock exchange, what would you say is the benefit of having a dual list in London for a TSX listed company rather than the ASX?
Well, I think that the UK, I think, is more of a generalist market, and it is a deeper market, than both Australia and Canada. And I think part of the thing that I would say about that is that we're increasingly seeing Australian listed miners coming to London. And again, what I will stress is that, this is not kind of you're removing Toronto listed, and we're not suggesting that. We're actually saying you're adding London, you're adding access to funds which have a UK mandate, and by the fact that you have the London listing, they can therefore invest in your stock. And I think that, invest in your stock. And I think that is something that is more likely to be additive if you have Toronto, to London than it would be with Australia, because I think that's more, obviously Australia is more of a mining focused market in the same way that Toronto is. I think there's more differentiation in London from an investor based perspective than you would find between Toronto and Australia. And quite frankly, the UK is by far the deepest market in Europe when it comes to assets under management, equity assets under management. And that's really what you're getting access to. Actively managed capital that can invest in you as a result of you adding the London listing. That amount of capital in London is very large. Obviously, you have to work very hard, through brokers and people like VT and Canaccord to get access to those guys and get them to invest in you. But the potential, size of that pool in the UK is just so large. And that's the opportunity.
James, maybe just one more for you. What are investors by way of minerals looking at the moment? Clearly, copper is very hot. Gold's been doing well. Are you seeing any other, intense buying opportunities?
Yeah, I think battery materials as a theme is one that is quite attractive at the moment. I think everyone knows that copper fits in quite nicely with that, but there are others that fit in also quite nicely within that. Obviously, lithium and increasingly the rare earth segment, subsegment, which is quite interesting as well. So I guess taking a step back, I think UK investors or London investors, particularly the generalist guys, will typically focus on the mainstream commodities. Anything that diverges away from that starts becoming quite a bit harder and more specialist, and therefore they'll rely a lot more on the specialist funds to lead the charge in terms of investing in that. So I think the commodities that will tend to focus on, at least for the time being, and I would say the foreseeable future, are those the mainstream commodities, and I think that's gold, copper, zinc, and then perhaps you can have the odd ones out like lithium, etc., that form part of a wider thematic, but it's really not a wide spectrum of commodities. But I think there is obviously that leaves a huge pool of potential companies that can come over to London that fit in with those commodities. And I think, just touching upon some of the points that Rusty and Chris made, I think the opportunity in London is still there in that, even though it's been a pretty busy time in terms of new listings, it's not a very deep bench in terms of high quality mining companies that are listed in London when you compare it to Toronto and Australia. And when you compare that to also kind of the level of investor interest that we're getting from those generalist funds in terms of looking for new mining ideas and new mining opportunities over and above the usual suspects that they have been seeing for the last decade, I think that does leave still quite a lot of room for new companies to come here and be very differentiated versus a much more competitive landscape in Toronto and Australia. So there's still much more room for new companies to come into market here.
Okay, so I think we're nearly done, but I'll just open up to the floor in case anybody else wants to comment on the dual listing process or any other themes. In which case, I'm going to thank you all very much. Rusty Bell, Chris Mayo, James Asensio, and Richard Williams. Thanks very much for joining us. We hope to see you all at PDAC next year. I think certainly in the UK, we're going to be released around the middle of June back into civilized society. And if you want to see any more of our videos, we've got a couple more on our website for PDAC, one on mining disclosures and one on investment in ESG. But for the time being, thanks very much for joining us, and thank you to our participants today.